The market is wrong about the risk. That is a direct, explosive claim from the April 2026 Macro Regime Monitor report by 20Quant. It's a bold statement, right? It totally challenges everything we think we know about current global economics, and it's practically designed to shatter the complacency of anyone who assumes we're just hitting a normal, cyclical bump in the road.
Hey everyone, and welcome to this explainer. Today we are unpacking 20Quant's urgent new intelligence report on the Great Fragmentation, a macro regime shift. If you're a focused learner looking for really clear, structured insights into why the global economy is going through a permanent fracture, well, you are in the exact right place. We're going to break down precisely what this macro regime shift means using the data and analysis straight from the source. Let's dive into it.
Section 1. The market is wrong. Physical scarcity versus demand disruption.
Okay, so the report argues forcefully that financial markets are dangerously mispricing recent geopolitical events as mere cyclical bumps. Why? Because they fundamentally misunderstand the exact nature of the shock. We are facing what they call physical scarcity. Now, this is not a simple demand problem where prices go up and consumers just buy a little less. No, physical scarcity is a structural constraint where critical inputs are just completely unavailable. When this happens, supply chains don't just bend, they completely break. The damage cascades non-linearly. We have essentially entered a 1970s-style physical scarcity regime, meaning markets built almost entirely around old demand-side models are flying totally blind to the very real threat of these physical constraints.
Let's ground this terrifying theory in reality for a second. Consider helium from Qatar. It's not just for party balloons, right? It is an absolute non-negotiable requirement for semiconductor fabrication. The report explicitly warns that a prolonged disruption in the Gulf doesn't just create a temporary bottleneck in chip supply, it literally threatens to shut down semiconductor production entirely. This is a live, immediate exposure that markets are currently just choosing to ignore.
Section 2. The transatlantic inflation split. A tale of two continents.
So this underlying physical scarcity is driving a massive wedge into the global economy. The United States and Europe are both battling inflation, sure, but standard global economic models are failing right now because the root causes are completely opposite. Over in the US, it's a domestic problem driven by hot demand and structural fiscal spending, but in Europe, it's an imported problem driven by a brutal energy supply shock. Let's break these down a little further.
In the US, demand is running extremely hot, and a massive part of that is fiscal policy. The sheer scale of government spending, notably cited in the report as the recent Big Beautiful Bill, is basically keeping the economy overheated. And this creates a fascinating structural conflict. The Federal Reserve needs to cool things down using monetary policy, but the federal government keeps turning up the heat with fiscal policy. It's like one foot is slamming the brakes while the other is flooring the gas pedal. There is really no clean resolution in sight for this constrained position.
But across the Atlantic, the story is entirely different. Eurozone headline inflation hit 2.5% year-on-year in March 2026. Honestly, that sounds pretty manageable. But buried underneath that number is a staggering 6.8% monthly surge in energy costs. That is a severe imported shock. The major risk identified here is that this massive energy supply shock converts into a full-blown demand shock, making a Q2 GDP contraction a highly realistic outcome, not just some extreme tail risk.
Which leads us to this absolutely critical number, 3.75%. The report warns that the European Central Bank may be forced to hike rates to 3.75% just to prevent this energy spike from embedding itself in wages and long-term price expectations. Think about that, raising rates into a weakening economy to fight inflation that originated completely abroad. It's the exact defining dilemma of the 1970s, and Europe is walking straight into it.
Section 3. Europe's Great Debt Debate, the push for pragmatic federalism. This massive energy crisis and all the ongoing geopolitical fragmentation are forcing Europe into a really paralyzing institutional debate over shared fiscal instruments. The centerpiece of this push for pragmatic federalism, championed by figures like Mario Draghi, is common debt. We're talking jointly and severally guaranteed EU bonds. But critics raise a central, very valid question. What happens when common debt removes the last layer of fiscal discipline? This opposition isn't irrational at all. There are legitimate fears out there, specifically regarding France's materially worsened debt dynamics and Germany's recent use of accounting structures to work around its own borrowing limits.
The measurable trade-offs here are stark.
On the side of urgency, the argument is that Europe desperately needs common debt to finance military rearmament and overhaul its energy infrastructure. These are massive objectives that simply cannot be funded through incremental adjustments to national budgets anymore. There's also the structural upside of creating a deep, liquid EU bond market that could finally rival US treasuries. But, balanced against all that is the argument for discipline, the worsening debt in France, those constitutional workarounds in Germany, and the ultimate fear of losing national fiscal discipline entirely. It's a profound debate, and both sides hold very measurable costs.
Section 4. Fraying political trust. The domestic reform bottleneck. So, all these external macro pressures, they're landing in highly polarized domestic environments, and it's completely stalling necessary action. Countries like Hungary and Slovakia are visible examples of this friction, but the Italian referendum on judicial and prosecutorial careers is a really prime example of the broader problem. Regardless of the actual legal merits of the reform, voters rejected the constitutional measure simply due to widespread suspicion of executive overreach. The analysis shows how culture war battles and deep institutional suspicion deplete the exact political capital needed to pass any meaningful economic reform. The report's conclusion on this matter is incredibly stark. When reform slows, the gap between what Europe needs to do and what it is actually capable of doing widens. This institutional distrust directly paralyzes the structural pipeline needed for Europe to achieve fiscal credibility, or honestly, to even qualify for those common debt instruments we were just talking about. Section 5. 3 rules for portfolios. Architecture for disciplined investing. So, what do we actually do with all this information? To snap investors out of any lingering complacency, the 20 Quant document leaves absolutely no room for doubt before delivering its tactical rules. Their mandate is clear. The regime has shifted. Positioning needs to reflect that. The authors walk us through 3 mandatory portfolio adjustments. Step 1. Stop waiting for normalization. Central banks are constrained. The Fed by fiscal policy, the ECB by imported inflation, and orthodox policy responses are simply off the table. Step 2. Take physical supply chain exposure seriously. And step 3, treat the US-Europe divergence as a permanent structural feature. Dollar assets and euro assets are responding to fundamentally different drivers right now. Passive diversification is definitely not going to capture this asymmetry. Let's elaborate a bit on step 2 because it ties right back to the very beginning of our explainer. The report stresses that indirect exposure in key physical inputs like gas, helium, semiconductors, and battery metals will produce sudden, non-linear portfolio surprises. These are inputs where physical scarcity can completely shock sectors that appear to have absolutely no direct connection to geopolitics or trade policy. If you rely purely on traditional demand models, passive diversification simply will not catch these hidden risks. The indirect exposure is exactly where the surprise sits. We're going to end this explainer with a direct challenge drawn from the core thesis of the report. Ask yourself, is your portfolio built for a smooth path back to target inflation, or is it built for the reality of the Great Fragmentation? If 20 Quant is right, any framework assuming a smooth return to normal is entirely mispricing the current environment. It's time to deeply evaluate whether your strategy reflects the world as it was or the physically constrained, fragmented world as it actually is today. Thank you so much for joining me to explore this vital source material. Keep learning, keep questioning, and I'll see you for the next explainer.